Welcome, everyone. Let's jump right into today's explainer. We are unpacking the fascinating second quarter 2026 earnings from Brookfield Business Corporation. You probably know them by their ticker, BBUC. Now, if you follow private equity or large-scale industrial investing at all, you know the macroeconomic environment has been, well, let's just call it incredibly dynamic lately. But what we're going to look at today is how Brookfield's core, highly disciplined strategy is actually playing out in real time, effectively compounding capital no matter what the broader market is doing.
To really grasp their results, we have to start with the foundational thesis of the company. It's perfectly summed up in this quote from their CEO, Anu Ranjan. We buy, build, and operate high-quality industrial and services businesses. I mean, it sounds incredibly simple, right? But actually executing this at a global scale, finding the right businesses, physically stepping in to fix and improve them, and then knowing exactly when it's time to sell, that is an intensely complex operation.
So here's our game plan for today. We'll quickly cover the Brookfield playbook, check out the Q2 financial snapshot, look at capital recycling in action, dive into their strategic new acquisitions, explore how they're driving efficiency with AI, and finally look at returning value to shareholders.
All right, Section 1, the Brookfield Playbook, Strategy in Motion.
It's really vital to remember that they created this vehicle specifically to give everyday investors access to a playbook that they've been refining for over 25 years. It brilliantly illustrates that core mantra: buy, build, operate, recycle. Step 1. You buy market-leading businesses that provide absolutely essential products or services. Step 2. You bring in immense operational expertise to improve their day-to-day operations and boost cash flows. And Step 3. When that asset is finally mature, you sell it. You recycle that capital right back into the ecosystem and start the whole process over again. As you'll see, today's Q2 numbers give us direct, undeniable proof that this playbook is working flawlessly.
Moving right along to Section 2, the Q2 financial snapshot, by the numbers.
Shifting our focus to the raw financial performance, think about the sheer growth in bottom-line profitability here. We're looking at a net income for shareholders of $37 million this quarter. When you compare that to the $26 million they posted in the exact same quarter last year, that's a highly impressive 42% jump year over year. It tells us that the underlying durability of their cash flows isn't just theoretical, it's driving real, tangible profitability.
But net income really only tells part of the story in the private equity world. Take a look at this figure. $587 million in adjusted EBITDA for the quarter. While that raw number is obviously massive, the big takeaway here is that it actually represents a 5% increase over the prior year, and that's when you exclude the impacts of their recent acquisitions and dispositions. Basically, it means their same-store, organic operations are consistently growing on their own. And just to ground us for a second, all the insights and data we're analyzing today are pulled directly from leadership's latest address to the market, the Q2 2026 results call on July 31st. So we are looking exactly at what management is signaling to Wall Street right now.
Okay, Section 3, capital recycling in action, unlocking liquidity.
Remember that final step of the playbook we talked about? Selling mature assets is how you unlock liquidity. Let's see how this builds across a timeline of their recent major exits. They've previously monetized assets like Altera and Latrobe, but just this quarter, they reached an agreement to sell Multiplex for about $650 million. This is a huge milestone, honestly, because Multiplex was one of the very last significant legacy assets left on their balance sheet from the original spin-out a decade ago. And you've got to look at the sheer pace they're moving at. Just last year, management set a 24-month target to generate $2 billion through capital recycling. Well, they have already hit $1.2 billion. That is 60% of their 2-year target achieved in less than a single year. They're executing these recycling goals brilliantly, even in what we all know is a pretty complex macroeconomic environment.
Which brings us to Section 4, Strategic New Acquisitions, Deploying that Capital.
So, with this massive mountain of cash they've generated, what exactly are they doing with it? In the second quarter alone, they committed $300 million to new acquisitions. Contrast that highly targeted $300 million deployed against the $1.2 billion they just generated in sales. This really showcases their incredible discipline. They aren't just out there buying to buy. They are hunting for very specific strategic opportunities. So what did they buy? 2 fascinating yet completely distinct businesses. First up, World Freight Company. It's an asset-light,
global air freight agent that serves 300 airlines. Second is Greg Distributors, which is a founder-owned Western Canadian industrial supplier with over 150,000 items sitting in inventory. Now, while they operate in entirely different sectors, both of these are mission-critical, recurring demand businesses. They are absolutely right for Brookfield's signature operational upgrades.
The absolutely crucial point here, though, is how they buy. Chief Financial Officer Jaspreet Dahal noted that these businesses were acquired at roughly 9 to 11 times EBITDA multiples. So, Brookfield is actively avoiding all the overpriced market hype. They're systematically buying these robust, somewhat fragmented businesses at an average 10x going in multiple, and they have very clear plans to drive that multiple way down through deep operational improvements. Next up, Section 5, Driving Efficiency with AI, the Future of Operations.
So how exactly are they making these operational improvements today? Well, Brookfield recently committed $100 million into OpenAI's deployment company, known as DeployCo. But listen, this isn't just a financial investment. It is a highly strategic partnership. CEO Anuj Ranjan pointed out that the real bottleneck in the industrial sector isn't the technology itself, it's actually the deployment of that technology at scale. This partnership gives Brookfield direct access to elite AI talent so they can rapidly implement custom solutions across their heavy industrial assets. We're talking about targeting hundreds of millions in run-rate cost savings.
Let me give you a brilliant show-don't-tell example of this in action right now at their portfolio company, Chamelix. Step 1. They installed machine learning sensors right on the manufacturing floor. Step 2. Those sensors constantly monitor ambient plant conditions, things like temperature and humidity. Step 3. The AI models automatically determine the exact optimal polymer blending settings. This literally eliminates all the manual trial and error, which radically reduces yield loss and production variability. It's a total game changer.
And they are doing the exact same thing at Clarios, which is their advanced energy storage operation. By installing sensors across the entire machine park, they've been able to optimize machine cycle times, vastly improve their maintenance schedules, and totally revolutionize their battery inventory management. This AI integration isn't some far-off future promise. It is happening right now across diverse assets to drive real, tangible efficiency.
Finally, Section 6, Returning Value to Shareholders, which is the ultimate goal. Okay, so we've seen how they buy, how they build with AI, and how they sell. But how does all this success actually benefit you, the investor holding the stock? The answer is aggressive, highly targeted capital return. Since they launched their buyback program early last year, they've repurchased a massive $300 million of their own shares. That actually includes $50 million executed just this quarter alone, and they're allocating another $150 million of the proceeds from recent sales specifically to fund even more repurchases.
Now you might be wondering, why are they buying back so much stock? Well, because management is seeing something the broader market might be completely missing. They are executing these repurchases at a nearly 50% discount to net asset value. Management is aggressively buying their own stock because they clearly see it trading at a massive discount to its true intrinsic value. I mean, when you can buy a dollar's worth of assets for 50 cents, you do it all day long.
And it's not just buybacks either. While they're scooping up their own shares at a steep discount, they're also providing a steady stream of income to investors. They just declared a quarterly dividend payout of 6.5 cents per Class A share, which is all set to be paid out this coming September.
Which leaves us with this final thought. Brookfield is currently sitting on a staggering $2.8 billion pro forma liquidity chest. They are systematically divesting legacy assets, they're acquiring high-quality companies at incredibly disciplined multiples, and they're using elite AI partnerships to radically transform their cash flows. The playbook is working, plain and simple. So the real question you have to ask yourself is, with a war chest that massive, what market-leading business will Brookfield acquire next? Thanks so much for joining us for this explainer, and we will see you next time.